One of the benefits of index investing is supposed to be broad diversification, but right now 36% of the S&P 500 index consists of just 7 stocks. If we look at the total US market, that number is 32%. That is the most extreme level of index concentration in US market history going back to 1927. US stock market valuations are also nearing their 1999 peaks, which were, of course, followed by a decade of flat, at best, US stock returns. I get it. This does seem concerning. If that handful of stocks declines in value, the effect on the overall market could be substantial. This is a movie we have seen before up here in Canada. In July of the year 2000, one stock made up about 36% of the entire Canadian market index, subsequently crashing, eventually becoming worthless, and dragging the market down with it. The good news is that mitigating the worst of these situations is not actually that hard. I'm Ben Felix, Chief Investment Officer at PWL Capital, and I'm going to tell you how to prepare for the aftermath of the AI bubble. All right, I've got to come clean up front. I don't actually know if there is an AI bubble. Nobody does. That's only knowable in hindsight. That being said, some wild stuff has been happening in the US stock market. Companies have been spending at a blistering rate to build out the infrastructure needed to capitalize on the supposed AI revolution. This type of spending often coincides with the development of revolutionary technologies. Railroad and internet stocks followed a similar path of high asset prices, massive investment, and an eventual painful fall in asset prices, which we might describe as a bubble after the fact. Stock price bubbles, or periods of unusually high stock prices followed by much lower prices, are an age-old feature of financial markets. They are often, but not always, sparked by some new technology that promises huge profits for those developing it. The history of technology bubbles goes back to at least the 1700s and has followed a similar pattern with each successive major technological innovation. In this video, I want to talk about the two main features of the current US market which seem to be causing some investors to worry. One is market valuations, the other is market concentration. These are two loosely related measures. Market valuations measure how expensive it is to buy the expected future earnings of companies, and market concentration measures how concentrated the market's total value is in a small number of stocks. High market valuations are generally associated with lower future returns, while market concentration has a much noisier relationship, if there's any relationship at all. Market valuations and market concentration may both increase around the development of new technologies simply due to the fact that as some companies rise in value due to their association with the new technology, they will make up a larger portion of the market. Bubbles are exciting on the way up, often inducing FOMO, fear of missing out, that may further feed into the bubble dynamics, and then they are painful on the way down, both psychologically and often economically or financially for the people who invested in them. Bubbles are not all bad though. High stock prices that arise from speculation about the profitability of a revolutionary technology can help to facilitate that technology's development and deployment into the economy. Classic examples are the massive spending on installing fiber optic cables in the late 90s and on installing railway track in the 1840s. In both cases, many of the companies involved were able to raise a ton of money and achieve temporarily high stock prices as excited investors piled in, but their share prices subsequently crashed. Bubbles do tend to come with waste, too much unused fiber optic cable, too much redundant railway track, but despite the waste, the infrastructure for the respective technologies does get created, paving the way for a potential economic golden age to follow. These productive bubbles are probably on net a good thing for the economy, even if they can be painful for investors. The pattern of investor excitement and high stock prices surrounding technological revolutions or potential technological revolutions goes back hundreds of years, and it always follows this similar path. Stock prices are driven up by some combination of high profit potential from the revolutionary technology, and once it starts rising, speculation that the associated stocks will continue rising. Eventually, prices do come back to earth, resulting in low returns for anyone who bought near the top. Whether that's what we're seeing in the US right now, again, can only be known in hindsight. Prices could remain high. The rapid rise in prices of the top US stocks has also been accompanied by rapid earnings growth. It's not pure hype. There is some economic substance here. What we do know is that a large portion of the US market's return, earnings growth, and capital expenditure has come from AI-related stocks, since the launch of ChatGPT. A September 2025 report from JP Morgan explains that AI-related stocks have accounted for 75% of S&P 500 returns, 80% of earnings growth, and 90% of capital spending growth since ChatGPT launched in November 2022. We also know that U.S. stock market concentration, which was already high, has shot up even further. Stock market concentration and high stock valuations are, again, different issues, but they can be related by the fact that a rapid rise in valuations for a small number of firms can also lead to market concentration. To be completely clear, in case I wasn't already, I am not taking a position on whether we are witnessing a bubble in the U.S. stock market, but I think it's useful to look at past instances of high stock market valuations and market concentration to understand the potential implications and lessons. The Canadian example that I mentioned earlier is even more extreme than what we're currently seeing in the US market. Northern Electric and Manufacturing Co. was spun off from Bell Canada in 1895. In 1998, it was renamed Nortel Networks. During the dotcom bubble, Nortel's early work in optical networking technologies propelled it to the forefront of the internet infrastructure revolution. It was making truly useful stuff that the world needed or thought it needed. Its stock price soared, creating huge amounts of wealth for investors and for the many employees who received stock-based compensation. Incredibly, the company peaked at over 36% of the Canadian stock market index, at the time called the TSE 300. Nortel, and thus the Canadian stock market, had extremely high valuations in August of the year 2000, peaking at a Shiller cyclically adjusted price-earnings ratio of 60.62, far surpassing the peak valuation of the U.S. stock market during the same dot-com period. The Shiller cyclically adjusted price-earnings ratio measures market prices against the index's 10-year average real historical earnings. On the assumption that long-term earnings growth tends to be steady, a high Shiller PE means that investors are paying a lot more for future earnings and should therefore expect lower future returns unless earnings end up being unusually high in the future, which can happen. Nortel's downfall started with a string of unprofitable internet-related acquisitions and was accelerated by the dot-com bubble popping. The result for the Canadian stock market was devastating. The Canadian TSE 300 index dropped by 43% between September 2000 and September 2002. That obviously hurts. There are two lessons that I think are important to explain here. First, while this drop was definitely painful, I don't want to minimize that, the market recovered by July 2005, and it went on to deliver strong returns, while the U.S. market, as I'll detail in a minute, struggled for more than a decade. Despite having been more concentrated, the Canadian market was more resilient than the U.S. market. The Nortel crash was, in hindsight, a short blip in a long track record of strong performance for Canadian stocks. Second, while the Canadian market as a whole was hurt by its exposure to Nortel, Canadian value stocks, a Canadian value stock index, so stocks with low prices relative to their fundamentals, did not crash when the overall market did, and it actually delivered even stronger returns than the market on the recovery. This will come up again in my next examples too. The U.S. market did not have such extreme concentration in 1999 as it does today or as Canada did back then, but it did have high stock prices, which were, in hindsight, mostly unjustified by fundamentals. Some companies like Microsoft and Amazon came through the other side and proved that there was real transformational potential in the internet, but the vast majority of companies that tried to capitalize on the internet failed. This led to the famous dot-com bubble and the subsequent lost decade for U.S. stocks. The U.S. market crashed starting around March of 2000 and, measured in Canadian dollar terms, remained flat or below flat until July of 2013. That is another brutal period of technology-induced high prices, leading to low realized stock returns for investors who bought at the peak. In this case, unlike with Nortel, the recovery was not so swift. Part of the problem is that the great financial crisis intervened as stock prices were starting to recover. Either way, this technology bust was painful for U.S. investors, or investors in U.S. stocks in general, and even more so for investors focused on U.S. technology stocks. It would have taken them even longer to recover. Similar to the Canadian example, an investor in U.S. value stocks, and to an even greater extent U.S. small-cap value stocks, fared much better over this long period of poor performance for the market as a whole. They earned positive returns while the market was flat, at best, for an extended period of time. It's also worth reiterating that Canadian stocks performed reasonably well over this period. Diversification is known as the only free lunch in investing for good reason. The main problem with diversification is behavioral. It inherently means that you always own the stuff that's performing well and the stuff that's performing poorly, which is not always so easy to do. Okay, so these two examples, the Canadian and the US example, they had high market valuations in common, but the Canadian market became much more concentrated than the US market. In the past, the US market has reached high concentration levels without going on to deliver poor future returns. Not quite as high as today, but still high. I looked at this within the US market going back to 1926. I sorted 10-year future returns on the starting level of market concentration in the top 7 stocks. There's a very slight negative correlation between market concentration and future returns, but it's not statistically significant, meaning there's a good chance it's just noise in the data. But statistical significance aside, it's still a weak relationship economically. A point that often seems to get lost in discussions of the US market's concentration is that many other markets around the world are far more concentrated. I mean, I gave you guys the Canada example, and yet they still manage to deliver positive returns, in some cases even more so than the US market. Looking back at the last 10 years of returns, just as an example, the weight of the top 7 stocks in the 10 largest stock markets, excluding the US, was 40.94%, so higher than the US. In November 2015, so we're looking back 10 years in history, Switzerland was the most concentrated market at 60.11% in the top 7 stocks, and Japan was the least concentrated at 16.91%. The return from November 1st, 2015 to November 26, 2025, measured in USD, was 8.44% on average for all of these countries. That does trail the US market return, but still delivers a meaningfully positive equity risk premium. Taiwan was one of the most concentrated markets in November 2015, and it outperformed the US market over the subsequent 10-year period. The overall relationship between market concentration and future returns across countries seems to be noisy at best. An interesting sort of anecdotal perspective is AT&T, which was broken up into smaller companies starting in 1982. It was the largest company in the US market at that time, and in prior decades, not when it was broken up, but in prior decades, it made up a larger portion of the US market than NVIDIA makes up today. The interesting question is, was the US market less risky after the breakup? I think that would be pretty hard to argue. You could maybe even argue the opposite. Something that does appear in the data, at least post-1950, is that returns can suffer over periods where concentration is falling. I think this again makes sense. If concentration comes from rising valuations for a handful of firms, falling valuations for those firms would lead to lagging returns. But even then, we're talking about less positive returns, not a total disaster. The relationship between market valuations and future returns is stronger, at least economically, both across markets and within the US market. To illustrate this, I looked at the relationship between the starting cyclically adjusted price-earnings ratio, the CAPE ratio, and the 10-year return for the 10 largest developed stock markets going back to 1982. I looked at rolling periods with a 1-month step. I acknowledge that there are potential problems with this setup, like difficulties in comparing the CAPE ratio across countries, and from a statistical perspective, the fact that I'm using these overlapping samples, the rolling periods of the 1-month step, it does make any conclusions drawn from the data statistically questionable. Now, that being said, there is a clear monotonic relationship between starting cyclically adjusted price-earnings ratio, so starting valuations, and future 10-year returns. When the CAPE ratio is higher at the start, future returns are lower. Again, this does not mean that the market must crash tomorrow or next week when valuations are high, but it might mean that it makes sense to moderate our expectations for future returns from the US market in particular due to its currently elevated valuations. The Japanese stock market had a crazy run leading up to 1990, eventually becoming the largest stock market in the world by market capitalization, surpassing even the US market for a period of time. Japan was viewed as this unstoppable economic powerhouse, and its stock market valuations reached levels rarely seen elsewhere in history. I'm not saying the US is today's Japan, but I think it's an important example to think about. At the end of 1989, the Japanese market did crash. So it had these crazy high valuations, and then prices do start to come down. The market really does crash. The crazy thing about the Japan example, though, is that it has not recovered in real terms, so if we adjust for inflation, to this day. So it crashes in the end of 1989, and now we're in almost 2026. And if you adjust for inflation, the Japanese market is still not recovered from the crash, or it's flat after the crash. Now, 2 things would have saved an investor in Japanese stocks in 1989. Diversification across markets. A globally diversified investor did just fine as the US market kind of took the torch of stock market dominance back from Japan with a vengeance. The US went on to absolutely perform exceptionally well, as Japan had done previously. And then the other thing that would have helped is diversification within the Japanese market itself. Despite Japan's stock market struggles over this long period of time, as with my previous examples, Japanese value and small cap value stocks have actually performed fine over this period. Now, again, this does not mean that I'm suggesting getting out of the US stock market. We could have had a very similar conversation to what we're having now in 2021 when US market valuations were high again. Not quite as high as today, but still high. That would have been a mistake. US stock returns have continued to be very positive since then. But what it does mean is not expecting the same rocket ship returns that the US market has been delivering to continue forever. The US stock market currently has these two defining features that are causing some investors to worry: high stock valuations and high market concentration. Market concentration, while seemingly problematic due to the potential impact of a few large firms faltering and bringing the market down with them, has not historically been as much of an issue as you might expect. Anecdotally, the Canadian market recovered from an extreme period of market concentration and high valuations during the dotcom bust more quickly than the less concentrated US market. Looking more broadly at the 10 largest non-US stock markets for the last 10 years, the relationship between concentration and future returns is seemingly non-existent. Looking at US returns from 1927 to 2024, there is a weak economic relationship that is not statistically significant between market concentration and future returns. Stock market valuations, on the other hand, are more impactful, and that is another concerning aspect of the US market right now. High current valuations, while not a perfect predictor of future returns, do seem to be at least somewhat related. This relationship, while it's economically strong, doesn't really hold up to statistical scrutiny for the simple reason that we don't have that many independent samples to draw conclusions from. Past market valuations tell us only a little bit about the future. It's always possible, as the US market has demonstrated in recent history, for high valuations to be followed by high returns and continued high valuations. Even if history tells us that that is an unlikely outcome, it is what we have seen. The main lessons from the information in this video, I think, are diversification and discipline, which I think are related. A properly diversified investor should be comfortable sticking with their portfolio through good times and bad, knowing they will always hold the losers. You have to accept that. Whatever's not doing well, if you're diversified, you probably own that. But you also own the winners. And people who are comfortable with their investment strategy understand that the winners that they own are going to have an edge over the losers in the long run, which is something that has been true throughout history. Thanks for watching. I'm Ben Felix, Chief Investment Officer at PWL Capital. If you enjoyed this video, please share it with someone in your life who's concerned about the AI bubble.